Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. This time around, we're going to talk about the iron butterfly. I've never heard about this, but Kevin Matris, our top options person here at Zacks.com, seems to have heard about this before, so grasshopper, why don't you fill us in on what the iron butterfly is?
I like the way you say that. Very cool. First off, this is definitely a new strategy. I mean, it's been around for a while, but I don't think we've talked about it here ever.
I can tell you for sure.
Right. But it's an option strategy that is seldom talked about, but it's a very, very cool strategy. I got a bunch of slides with me, so let me kind of go through this very slowly. All right?
Okay, sure. Show us how it works.
First off, it is considered a neutral strategy, and you would do this if you believe a stock will trade within a certain range by its options expiration. It's usually put on as a credit, and it has a limited upside, but it also has a limited risk.
Okay, now we get into the working parts, right?
Right. So the trade consists of writing an at-the-money call and an at-the-money put. Then you're going to be buying an out-of-the-money call and an out-of-the-money put. Since I put this on for myself recently in Apple, I'm just going to use my trade as an example to kind of walk you through all of the parts. So first off, here's what it is. We're going to dissect it in just a bit, but let me just see if I can outline it first. All right. We sold, or I should say I sold, to open 1 September 2010 260 call at a premium of $1,271, which means I collected $1,271. I also then bought to open 1 September 270 call at a premium of $835, which means I paid $835 to put this on. I also sold to open 1 September 260 put at $1,365, which means I collected another $1,365. And then I also turned around and bought 1 September 2010 250 put at a premium of $925, which means I paid $925 for that. So we ended up collecting $436 on the call side. We collected $440 on the put side, and that means we received a total credit of $876 to put the trade on. Now, essentially what we did here was we put on two spreads. We put on a bear call spread, and we put on a bull put spread. Another way of looking at this also is that we put on a short straddle, that is the short 260 call and short 260 put, and a long strangle, which is the long 270 call and the long 270 put, or excuse me, the long 250 put. But regardless of how you look at it, whether you look at it as two spreads or whether you look at it as a strangle and a straddle, the fact of the matter is this strategy, this combination is called an iron butterfly, and it's a very, very cool strategy. We're going to talk a little bit more about this, all the details in just a second.
So how exactly do you make money on this?
All right, here we go. The maximum profit on this trade is the total credit that was collected, which in this case is $876. The maximum loss is the size of the spread in either direction, which in this case means it's a $10 spread, less the credit received, which is $876, for a maximum loss of $124. So even though we're talking about receiving a profit, potential profit of $876, under the worst case scenario, your risk is always limited to no more than $124. So that's pretty cool.
Yeah.
Now,
I would say.
Right, so the maximum profit though, let's go over this. The maximum profit will only be seen, however, is if Apple closes at $260 at expiration. Expiration on this particular trade is September 17th, 2010, all right? The reason why you're going to receive your maximum payout at $260 is because at that price, all the options will expire worthless, which means I'll keep the entire $876 credit. Now, as Apple moves away from $260, my profit will become lessened. However, though, you're only going to experience your maximum loss if it goes outside of the range of $270 on the upside and $250 on the downside. So here's how it works. Only if Apple closes above $270 or below 250 at expiration, could I lose the maximum 124? And the reason why that is because once again, you have the spread of $10, so that's what you're losing, but you're also collecting the 436, you're collecting the 440, which means your net loss is 124. Now, if I was going to get a little bit more granular, here's how it works on each level.
All right.
If you had the 260 call that you wrote, right? At expiration, let's say it was at $280 at expiration. At expiration, that 260 call would be worth $2,000. But I collected $1,271, which means I would have a loss on that particular option of $729. The 270 call I bought would be worth $1,000, but I paid $835, so that would be a gain of $165. But both puts would expire worthless, which means I would have a gain of $440. That is how I get the total loss of $124. So it's a very, very cool strategy. And like I said earlier, it's almost too good to pass up, because if you believe you have defined a stock that's going to trade within a certain range, this one is actually showing a reward to risk ratio of like 6 to 1. So I think that that's pretty cool. Now, here's what you want to consider. It's unlikely that Apple or any stock is going to expire perfectly at those two strikes that you wrote. But if it trades within maybe a couple of bucks on either side of that, you're still talking about potentially getting $600 or $700 profit out of a max of maybe $876. So it's very, very cool. The other thing, though, that you should consider is this. If you find this position, as you're getting closer and closer to expiration, once you see this position is, let's say, close to 90% profitable, in other words, you've already achieved roughly 90% of your maximum potential profit, you may want to consider getting out. Because at that point, you've already made about $800. It's silly to risk $800 for an additional maybe 70 or 80 bucks. Because what you want to remember is that even on the last day, if that stock were to spike up or spike down, all of that money that you've already made could be completely lost if you got greedy and stuck it out too long. So once you see that this position is very, very close to being maximally profitable, you may just want to take that off. But again, it's a very cool strategy. If you believe you've defined a stock where you believe it's going to be trading in a range, and you look at the options and you realize you can gain a pretty fat premium, I would say this is definitely one to consider.
Yeah, it is kind of, complex, and so that's why I will encourage you to go to Zacks.com if you're not already there. Scroll down to our options section on the homepage for a printed version of this particular strategy. Sometimes if you listen to it, you watch it on the video, you follow along in the text version, it makes it a little bit more understandable. It just helps complete the picture for you a little bit, especially on these more complex strategies. But that is it from our iron options trader himself, Kevin Matris, with more information to help you know your options. With Kevin, I'm Terry Ruffalo.